All right, welcome to Capital Minds. Today, we're doing something a little different. We're not just going to talk about investing. Nope, we're putting you right in the driver's seat. For the next few minutes, I want you to imagine you're starting a year-long journey on Wall Street, facing the exact same choices, risks, and rewards as the pros. Let's dive in.
And our guide for this whole experience is the late, great Charlie Munger. Now, his whole philosophy, it wasn't about finding some secret formula for success. It was actually the opposite. It was about figuring out all the ways you could possibly fail and then just not doing those things. It's a powerful way of thinking called inversion.
And that really gets to the heart of what we're doing today, right? What if the real key to getting ahead wasn't about chasing the next big thing, but about deeply understanding all the hidden traps and mistakes that blow up most people's portfolios?
Okay, so here's the mission, should you choose to accept it. You've got $20,000 of starting capital, and you've got 36 weeks on the clock. Your job? To navigate the wild, unpredictable world of the stock market. The goal here isn't just to get rich quick. It's to survive, learn, and come out smarter on the other side.
Okay, so before we hit go on this challenge, we got to make sure you have the right gear. Every game has its own rules, its own language, so let's quickly stock your financial toolkit so you know exactly what moves you can make.
First up, the basics, stocks. When you buy a share of a company like Apple, you're not just buying a blip on a screen. You're literally buying a tiny, tiny piece of the whole operation, a fraction of every single iPhone they sell, a sliver of every App Store purchase. You become an owner.
Next, we have bonds. Just think of these as you playing the role of the bank. You're loaning your money to a big company or even the government, and they promise to pay you back with interest. But here's the catch, and you really need to burn this into your brain. It's what I call the iron law of bonds. When new interest rates go up, the value of your old lower rate bond goes down. Super important.
Now we get into options. This is where things can get really powerful and really dangerous. The best way to think about them is like placing a reservation. A call option is your reservation to buy a stock if you think it's heading up. A put option is your reservation to sell if you think it's going down. The magic word here is right, not obligation. You're paying a small fee for the choice, and you can totally walk away if the deal goes sour.
Let's make that real. Say you're bullish on NVIDIA. You spend $1,200 on a call option. The stock then has a great week and rallies. Suddenly, that small $1,200 bet could be worth $5,000. That's a mind-blowing 317% gain. But, and this is a huge but, if that stock goes sideways or down, poof, that $1,200 could vanish. Just gone. And last in our toolkit, futures. Unlike options, this is a binding contract. You're locking yourself in. The real monster here is something called leverage. You can control a huge amount of an asset with just a little bit of money. Sounds great, right? But it means a tiny 5% price move against you could spark a catastrophic 75% loss. This, my friends, is the absolute deep end of the pool.
All right, you've got your tools, but tools are pretty useless without a solid game plan, a philosophy. For that, let's turn to the absolute legends of the game, Warren Buffett and Charlie Munger.
This is it. The single, most profound, most important rule in all of investing, straight from Buffett. It's not about being a genius stock picker. It's about obsessively protecting your capital. Because the math of losses is just brutal. You lose 50%, you need to make 100% on your next trade just to get back to where you started. But here's the thing. Losing money isn't just about a dramatic market crash you see on the news. No, the real threats, they're often the silent killers. The ones that slowly bleed your account dry when you're not even looking. Let's shine a light on them.
So welcome to the real world, where the house always takes a cut. Every single thing you do, every trade, every fund you buy, it has a cost. These are those hidden wealth destroyers Munger was always warning about.
I mean, just look at this. A few bucks here for a stock trade, a fee for every options contract, a percentage drained from your mutual fund every single year. On their own, they seem like nothing, right? But trust me, over time, these little bites add up to a huge chunk of your money.
And this right here shows you the damage in black and white. That tiny, innocent-looking 1% annual fee on your 20 grand doesn't just cost you a little bit each year. Over 30 years, it literally robs you of more than $37,000. That's a car. That's a down payment on a house. It is the tyranny of compounding costs.
And then there's Uncle Sam, your silent partner who always gets a piece of the action. But look at the difference here. If you flip a stock in under a year for a profit, you can get hammered with taxes. But if you just wait a little longer, hold it for more than a year, the tax rate gets slashed. It's simple. In investing, patience literally pays off.
Okay, you've got the tools. You know the hidden traps. Now, it's game time. It's time to step into the arena and face the chaos of the market, where anything can happen and your best-laid plans will be put to the test.
So imagine this. You're cruising along. It's week 17, your portfolio's looking pretty good. You're feeling confident. And then, bam, this event card drops. A total surprise announcement from the Federal Reserve.
The Fed hikes interest rates way more than anyone expected. And remember that iron law of bonds? Their prices get hammered. High-flying tech stocks? Crushed. Your portfolio is a sea of red. So what's the play? Do you panic sell and lock in your losses? Do you grit your teeth and hold on for dear life? What's your move?
You managed to survive that, but guess what? The market's not done with you yet. A little later in our simulation, another disaster hits, and this one is personal. It's aimed right at one of your biggest holdings.
The company completely whiffs on its earnings report. The stock doesn't just drift down, it gaps down. It opens 22% lower the next morning. And your safety net, your stop-loss order? Totally useless. The price jumped right over it. Man, that is a total gut punch. The question is simple, but it's agonizing. Do you sell, take the massive hit, and live to fight another day? Or do you double down, believing you were right? This is where fortunes are made and lost.
So after 36 weeks of absolute chaos, of dodging bullets and making these gut-wrenching calls, you've made it to the end. But listen, the real prize here, it's not the final dollar amount in your account. No, it's the wisdom, the scar tissue you've picked up along the way.
Our simulation might be over, but the real game of investing? That's a marathon, not a sprint. And your greatest superpower in that game is time. Just look at this number. That is not a typo. That is the difference in your final wealth from your original $20,000 by investing for 40 years instead of just 10. That is the unbelievable, world-changing magic of compounding.
And that really brings us full circle, back to Buffett's greatest piece of wisdom. The best investment you can ever make, it's not in a stock, it's in yourself. The time we spend here learning the ways to lose so we know what to avoid, that is the real treasure. Because knowledge is the one asset no market crash can ever take from you. The more you learn, the more you earn. Our simulation's over, but your real journey, it's just getting started. So what's the first move you're gonna make?